Hello and welcome to Portfolio Matters Weekly Update, week 79. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Keith, what have we got this week?
Thank you, Richard. Well, there's a lot going on in the world and almost none of it is good. So, news this week. Well, we have had renewed COVID outbreaks in China, and they have put restrictions on around 30 million people. There's also been lots of pictures on social media of a banking crisis in Henan province. Now, what is going on? The Chinese certainly have enough financial resources to refinance their banking system. So it's interesting that they're choosing not to. What on earth's going on? Something to watch. In Sri Lanka, where the government has defaulted on its debts, it's now running out of foreign currency, which means it can't buy fuel. That has led to a political crisis and, frankly, total societal breakdown. And we are going into an energy crisis this winter. Energy crisis leads to political crisis, something to watch. And in Italy, which we've talked about many times because it is highly indebted and a potential source of stress to the Eurozone, the Draghi government has essentially fallen apart. And Mario Draghi presented his resignation to the president last night and it was rejected. But they don't seem to have a working government in Italy currently. Markets are currently taking this quite well. But going into an energy crisis, Italy does not have a functioning government. In the Netherlands, there are protests over EU limits on nitrogen emissions, which has led to lots of roadblocks. In the US, we had some very important economic data. So CPI came in hot at 9.1%. We'll go through all this as we go through the weekly. The jobs report was strong. Canada raised its interest rate by 100 basis points, and the market is expecting the US to raise rates by between 75 and 100 basis points at its coming meeting on the 26th to the 27th of July. So some charts related to the news. So this is Dutch farmers protesting, and the Dutch are on the left. The Germans and various other people have joined them on the right. So this is a spreading protest about restrictions on farmers caused by new EU emission standards. In China, we have a rise in COVID infections, and frankly, if they keep on with their zero COVID policy, they're likely to go back into lockdown. And you'll see later that the latest Chinese data depicts an economy which is not performing very well.
Just a quick aside on that, Keith. So my daughter had COVID in after Christmas. She wasn't very well at all, and she's got it again.
Yeah, friends of ours have had it 3 times. So
yeah, I mean, the idea you could lock down your way out of it is impossible, is absurd.
Yeah, these are the latest odds on the next Fed rate rise, and suddenly we're talking about 100 basis point rises. 83.3% chance of a rise of 100 basis points. The next Fed meeting in 2 weeks' time. Sorry, back to China. This is where the COVID cases are and close to the industrial heartland. So if they lock down, that's going to have severe economic repercussions in China. Okay, on to this week's economic data. So the big news was US non-farm payrolls, and they were strong. So the expectation was for a rise of 300,000 jobs in the US in June, It actually came in at 372,000, beating expectations. It was slightly down on May. Earnings growth, however, slowed and was below expectations. So the expectation was for year-on-year earnings growth in the US of 5.2%, came in at 5.1%, down from May. And US consumer inflation expectations for the 1 year forward continue to rise, beating expectations. So last month it was 6.6%. This month, US consumers are expecting inflation of 6.8%. The Fed needs to raise rates to get that back under control. We also had US CPI numbers, and they were really not very reassuring. So CPI rose from 8.6% in May to 9.1% in June. And we have a section on this, we'll go through it, but essentially inflation is broadening and spreading to services and is persistent, and the US is going to have to raise rates to get it under control. The core, however, slowed from May to 5.9% in June, but even that was above expectations. In the EU, the sentiment, consumer sentiment, just gets worse and worse. It was minus 28 in July and is expected to worsen to minus 33. It actually came in at minus 54. Astonishingly bad numbers. Good news, the UK has proved remarkably resilient. The May number showed GDP growth of plus 0.5%. So the UK economy bounced back slightly in May. And year on year, it was grew at 3.5%, which is actually perfectly respectable. Now, we also had some quarterly data for China, and this was bad. So year on year GDP growth in Q2 was only 0.4%, missing expectations by a margin, and quarterly growth was minus 2.6% annualized. Really not good. Richard, charts.
Thanks, Keith. The US non-farm payrolls showing very healthy employment still, and the US unemployment rate really low and staying low at the moment. The US labour force participation rate has seems to have stabilised at a post-COVID low point, but higher, much higher than it has been. US hourly earnings year on year 5%, not enough to keep up with inflation. And I read this morning US is going to be getting train drivers strikes. Seen that before, haven't we? We've got it here. And I think we are now in a wage price spiral. And the US 1 year ahead consumer inflation's expectations, I think, suggests that we really are in a wage price spiral. This is really quite unpleasant. And US CPI, I'm reminded of what we were saying about European CPI and European PPI a few months ago, and the US seems to be following suit. And US core is just ticked down. Core, mind you, excludes energy and food, so I'm not quite sure what purpose it serves. I guess it's what you need to live if you're a robot running off solar power. US initial jobless claims, pretty stable, pretty low. And continuing jobless claims, again, pretty stable and pretty low.
But in both those cases, there has been a slight uptick in the last couple of months.
Yeah. And the 30-year mortgage rate is continuing to rise, basically. And the EU economic sentiment indicator has fallen fast to minus 50, which is almost as low as it was in 2008, and lower than it was in COVID, which is a poor sign, I would say. UK GDP growth month on month, as Keith said, May was a pretty healthy number. China GDP growth year on year, 0. I'm not quite sure that I believe that, but given the scale of their lockdowns, and quarter on quarter, they're a mess, basically.
Yeah.
So, I mean, in summary, we've got the US jobs report, which is suggesting the economy is still strong, but there's other data suggesting that the economy is less strong. US inflation beating expectations, so the Fed will probably raise rates significantly higher, and I'm not quite sure to what extent the market have priced that in, and particularly the stock market. And the UK economy is looking good in May. I mean, one swallow doesn't make a summer. Chinese economy, I think, is in real trouble.
Okay, thank you, Richard. On to one chart, and the one chart this week is the dollar index, which is rising really quickly. And I wanted to highlight the periods in which this has happened before. And we are now facing a world economy where in Europe, we're heading into an energy crisis. China has an unsustainable COVID policy. And also it has, for the last 20 years, had an unsustainable property boom that now seems to be rolling over. And the Chinese economy seems to be based on continued infrastructure investment and the belief that Chinese consumers will buy endless amounts of investment flats. And that would appear to finally be coming to an end. So the only economy which is doing okay is the US, and the US is essentially energy independent, which puts it in a great competitive advantage. Now, the dollar index has risen quite quickly, but if you look back to 1982, it rose for a very long time and essentially doubled as Volcker raised rates. So I would be wary of calling a peak in the dollar index.
I think so. I think as the world falls further into, I think, a stagflationary recession, the dollar will look increasingly attractive.
Yeah, absolutely. And the Fed has committed to raise rates hard to bring US inflation under control. And I would contrast that strongly with the UK, the EU, where the latest rumors are that the plan they have to stop fragmentation,
this anti-fragmentation rule or whatever
is essentially unlimited bond purchases.
Yeah.
And in Japan, they're doing unlimited QE. So the dollar looks like a hard currency. So what are the investment implications of dollar strength? Well, it's bad for commodities priced in dollars, including gold. It's bad for countries and companies with dollar debts and local currency assets, that should read. So expect more emerging market debt defaults. We've already seen a debt default in Sri Lanka, and we are expecting more to follow. And expect financial stress for European corporates with dollar debts as Europe goes into an energy crisis. It will also have effects on US companies, depending on the balance between their requirement for energy, which is cheap in the US, and how much of their earnings come from overseas, where high dollar is going to weaken their competitiveness. For investors, the bottom line is you want to be holding US dollar assets, because I think the dollar index is going to continue to rise.
Just a comment on gold, Keith, which is obviously a rising dollar will affect the price of gold in dollars, but if your local currency is not dollars, then as the dollar index rises, the value of your gold goes up. So that's a question of where you're domiciled, basically.
Yes, I agree with that. Okay, on to inflation watch, Richard.
Thanks, Keith. So everywhere is experiencing significant inflation still, and I think that the transient phase of inflation is now past, and the credibility of central bankers has declined as a consequence. So we can see here that CPI in the UK and the US and the EU is all up, and Japan was unchanged. German CPI was somewhat mysteriously down. I'm not quite sure what caused that. And core CPI, which, as I said, it excludes energy and food, so as far as I'm concerned, is useless, was down for all of them. I think that may be why core CPI is used by central banks, because it paints a false picture. And in the UK, RPI in May was up by nearly 12%. And we are suffering significant purchasing power degradation. And that is leading to a significant pressure, I think, on businesses that are in the discretionary sector. And I don't see it getting any better. The pressures on governments all around the world are enormous, and in some senses, the irreconcilable. So supply. This chart shows that supply chain pressures are easing a little bit. I mean, they're clearly not back to where they were for many, many years. We'll have to see, but it may be that that particular inflationary impetus is declining somewhat. US M2 money supply change has fallen to below zero. In other words, the US money supply is now beginning to contract, and that is a consequence of QT. How long they can do QT for before the economy starts to implode in the US is anybody's guess, but my guess is not very long.
I agree, Richard. I don't think they'll be able to reduce the balance sheet by anywhere near as much as their intentions. But this is monetary tightening, and it has the effect of raising real interest rates. And how much is open to debate.
And then we have US banks lending. This is a bit of a tricky chart to interpret because there's basically lines going everywhere. But basically, since Q3 2021, commercial loans have risen, or rather the growth, has been a significant growth in commercial lending. There's been a significant growth in credit card spending, and all bank credit is continuing to grow at around about 10%, which suggests that credit growth is continuing to help fuel the US economy.
Well, on your point about a wage price spiral, well, if you're a business and your revenues are growing with inflation at 9.1%, and you can borrow at around the Fed rate, well, it's like 2.25%, then you're going to borrow as much as you can, aren't you? And that will increase credit, increase the velocity of money, and add to inflation. So we're seeing the sort of corporate equivalent of a wage price spiral.
So services prices, we're starting to see significant increase in services prices, which suggests, as the note says, that inflation is broadening across the US. It's all indicative of the beginning of a wage price spiral, I think. Flexibility appears to have peaked. Sticky prices are rising steadily. I mean, this is basically what I think we've been saying for a long time, that we have generalized inflation. It is lasting for long enough, it is high enough that everything is being affected by it. And there is no quick fix to this, in my view. Sticky prices rising fastest in 40 years. And this is just beginning to happen. And so in periods of high inflation, it's always been that the inflation is not high and constant. The rate of inflation can fluctuate really quite dramatically, but the overall effect, when averaged out over a period of time, is continuous and high inflation. And the question here is: are we going to see what perhaps we saw in the 1970s, with those sort of two big peaks? What are we going to see? We don't know. But if inflation starts to fall off in the next few months, doesn't mean we're out of the woods. It may mean that we are, or it may mean that there's another big spike to come.
Yeah, the other thing I'd say is the impact of these inflationary periods is essentially the area underneath the line. And so the longer the inflation lasts, the more of an impact on prices it has. Yeah. And I am expecting inflation to peak and then come down quite quickly, but don't know where that peak will come, although we are seeing now peaks in commodity prices, including in oil.
The market is assuming that inflation is going to drop fairly steadily. Long-term estimates are lower than they were a year ago. I don't know. I'm slightly dubious, I have to say.
I just find that absolutely astonishing, given the rise in inflation over that period.
Yeah.
How long-term inflation expectations can have fallen. So absolutely amazing.
So we've got US core inflation, which, as we've said, is a fairly useless number. It's been in decline for 3 months, but headline inflation continues to leap higher, which is the inflation that everybody experiences. US inflation, we know now, is broadening into services, and there will be a wage price spiral in the US. I'm pretty certain of that. And the market is erroneously expecting inflation to fall back quite quickly.
Okay, on to recession watch. Thank you, Richard. So, and actually, before we get into recession watch, one thing I notice is that there is much less discussion of inflation in the markets and much more discussion of potential recession. And so we have more charts on recession. So first thing is the yield curve is now inverted again, and inverted more seriously than it was a couple of months ago. And the 3-month to 10-year yield is also flattening fast. So it's not potentially not just the 2 10-year, which is going into inversion. We have QT, which is only just begun, and that will tighten rates further. But as we've discussed, we are skeptical about how long this will last and how much the Fed will actually be able to shrink its balance sheet. As a result, money supply growth has stalled and is negative, and that is potentially bad for the economy. PMIs are shrinking fast, and we have previously talked a lot about the importance of the construction sector in the business cycle, and you'll notice that construction sector PMIs are falling very quickly. And on that note, that is because US housing is really unaffordable. Rates are rising and house prices have risen over 20% in the last year, and that's a terrible combination. So the ratio of house prices to per capita disposable income is the most, even more unaffordable than during the great financial crisis. And unsurprisingly, US home buyers are getting cold feet and are backing out of purchases they had previously agreed. And demand for second homes is falling quickly. It jumped up during the COVID pandemic, and now it is falling again. Business investment forecasts are falling quickly, although they are still positive. But this is a very good leading indicator. When business investment starts falling, that's a key driver of demand. It's coming off rapidly. We are worried about the impact of the coming energy crisis in Europe on the EU financial sector, and so is the market. And CDS on European banks is rising steadily, and frankly, I think this is going to get a lot worse.
This is interesting, Keith, actually, because I think there are a number of European banks that are really unsafe.
Yeah, absolutely. And this is visits to US shopping malls. Thank you to our Discord member, Draw It, for sending us this. And you'll see that in June, growth has stalled in indoor malls, and outlet malls are in decline, as they have been for a few months now. So has the US consumer peaked? And US auto sales have totally collapsed. Now, part of that is supply chain. But historically, there's been this correlation between employment and auto sales. If that were to hold, we expect to see employment fall over in the next few months.
Yeah.
Shipping activity is slowing down, so global trade is slowing down. And that would tend to mean that the business outlook is falling. And the inventory cycle is turning. So merchants have bought too much inventory. They will be cutting down on their orders to factories, and that will exacerbate the slowdown in manufacturing activity. Now, we had some numbers from the latest survey of American small businesses, and they were wholly negative. So this is their economic outlook, and it is the worst it's been in 40 years. And their hiring intentions, unsurprisingly, are falling. So this is in contradiction to the strong jobs report.
Yeah.
And they're increasingly pessimistic about their sales prospects. So in summary, there's just a broad set of economic indicators that are signaling that the US economy and the global economy is slowing.
And I remember, Keith, they say that if the US sneezes, the world catches a cold.
Yeah.
And if the US catches a cold, I'm not sure what the world's got, but it's not very nice. So let's have a look at the jobs report in some more detail. So the US economy is continuing to create jobs. And this is the contradictory data that Keith has just run through with the recessionary data, or the data suggesting recession is on its way. And yet the US economy, in terms of jobs, is not suggesting the recession is on its way.
And we've talked previously about the importance of the construction sector. And I'd highlight the fact that employment in the construction sector was still growing in June. So that's good.
This is how quickly jobs that were lost during a recession have been recovered. And the COVID recession is the quickest recovery that we see. And which is sort of remarkable, and probably due to a great extent to all the government funding that came out as a consequence of COVID. And the participation rate, as we saw earlier, hasn't risen back to pre-COVID levels. So people appear to have permanently left the workforce.
Yeah, and we've talked previously about how a lot of that appears to be long COVID. The UK is estimating something like 1% of the workforce has permanently left due to illness.
Workers looking for full-time work apparently can find it. So the amount of part-time working is dropping, continuing to drop. And the level of people who've been unemployed for more than 26 weeks, continuing to fall after COVID, and all indicating a healthy US jobs market. And we still have more job openings than people to fill them. The issue, of course, is that payrolls are a lagging indicator. People worry that business is going to slow down. They then see that business is slowing down. They then make people redundant.
This is showing that if 0 is the average start of recession, what it's showing is that this month's payroll number is much higher than you would expect at the start of recession. So these are all median numbers. And you see that growth over the last year is just much stronger than you would expect going into recession.
So have we seen a peak in US job openings? This is showing a correlation between a sub-index of called the Human Resources Sub-Index of the S&P 500 and the US jobs openings report. And if this correlation continues, we're going to see jobs openings starting to fall quite rapidly. I mean, I don't know. You can't really say this is a trend, can you? This drop in non-farm openings, it remains to be seen. I'd like to rise a quick rate. So there's no indication from the employment information that the US economy is slowing, but the employment information is a lagging indicator. So watch this space.
Thank you, Richard. Well, GavCal Economics this week had a bullish piece saying that the US economy was not in danger of going into recession. And I always think it's very important to listen to voices that contradict your own. And obviously, we think the US economy is going into recession. So I'd like to go through their argument for why they don't think that's going to happen. And so they point out that real interest rates are very strongly negative. So if you look at CPI and then subtract the 10-year yield, real interest rates are hugely negative, and that is very stimulatory, and it would be unusual to have a recession when real interest rates are so low. And if you look at previous recessions, you'll see they have all occurred when real rates are strongly positive, not when they're very strongly negative. And it would be unusual to have a recession when the real policy rate is this negative. Generally, it has to be positive. And if we look at mortgage rates, well, mortgage rates have risen very quickly, but they are only back to where they were, 15 years ago. They're low by historic standards. If you go back to 1982, they were approaching 20%. So yes, they're high, but they're not that high. And the jobs report just shows the US economy is red hot. These are very strong job opening numbers. Remember, there are more job openings than there are unemployed people to fill them. And it's difficult to see a recession when that is the case. Housing starts remain strong, and though they may have peaked, you'll see from previous recessions that housing starts peak at least a year, maybe 18 months before the start of a recession. So there's no indication from housing starts that a recession is anywhere near close. And if we think about the US economy in Keynesian terms, aggregate demand, well, average wages in real terms are falling. But remember that we've had very strong jobs growth. So the total amount of aggregate spending by employees is rising very strongly. So aggregate demand is rising strongly, and that should support the economy. And above all, US consumers have vast financial resources due to government largesse during the COVID pandemic. Everyone has savings, and which they can draw on to support consumption. So I agree with several of the points that Gavkal make. In particular, the strong jobs market and actually aggregate income growth is very strong, supporting demand. And consumers certainly have a lot of savings to support spending. However, I think all their arguments based on interest rates are just wrong, because they take no account of the increase in debt over that period. And so the financialization of the economy means there's vastly more debt, and that means it's more sensitive to small changes in interest rates. And we're now having large changes in interest rates, and that will suck demand out of the economy. Richard.
Yes, I think he's basically wrong. I mean, I agree that the consumers do appear to have more to spend, although it'd actually be interesting to see what the aggregate amount they have to spend is, rather than seeing it divided up into different sectors, because it's actually the total amount available to spend that is, particularly in the brackets where people are basically spending all their money in order to survive the month, as it were. I think they're the ones who are key in determining whether there's a recession or not. I mean, the housing market is unaffordable in the US now, and to suggest that just because interest rates are low, the housing market is affordable when it clearly isn't affordable is nonsense.
Yeah,
I think that's a huge weakness in his argument. His argument takes no account of quantitative tightening, which we all know from experience is deeply tightens financial conditions and is basically a recessionary activity. And I think there's always this tendency to overanalyze things. This is what happened last time, so the same thing's going to happen this time. And as you say, the world's a very different place to how it has been. Even the recessions 20 years ago, the world's a very different place. So I think a lot of the analogies, that the comparatives actually are invalid.
So on that point, this is a chart that shows essentially the sensitivity of the US federal budget to rises in interest rates. So the blue line is the average interest rate paid by the federal government, and the orange line is the percent of federal tax revenue paid by the government. So if the blue line were to head up to where it has been, let's say 5%, which is where it was only 15 years ago, then the orange line would head up to around 35%.
Or triple.
Yes.
Or triple.
So the budget would become completely unsustainable.
US budget already has a budget deficit, and that would add 30% or so to the budget deficit.
Absolutely. So using historic interest rate comparisons is just very, very misleading, because we've had a huge increase in debt over the period.
And actually, Louis Vincent Gavkal, I have respect for him. A lot of what he says is very sensible. I'm surprised he's come out with what I consider to be a load of twaddle.
Well, I think desperately trying to clutch at straws to come up with a bullish argument. He does make a few good points, but all the ones based on interest rates, I just don't think are valid.
Yeah.
So in summary, I think that looking at these big macro overviews and trying to forecast the direction of the economy from these first principles is fraught with difficulty. There are always good reasons why the economy should be growing or contracting. Actually, a lot depends on animal spirits. I mean, whether consumers and entrepreneurs actually feel good about the economy and whether they want to spend their savings. They have savings. Do they actually want to spend them? So the bottom line is watch the data.
Yep.
And so I think trying to predict anything from these basic fundamentals is very difficult. So now we're going to do a special extended section on the impending European energy crisis. Now, this is too long for the weekly, so I'm going to split it out into a special podcast, which I urge you all to watch. Okay, so moving on, the Bank of International Settlement had an interesting paper on the causes of high inflation. And their argument is that high inflation is always the result of a wage price spiral. And this is not a one-off. You get extended, embedded inflation from a feedback loop between high inflation and high wage demands, and those wage demands being met. And in particular, we normally think of high inflation as being caused by unions demanding high wages and bringing the economy to a halt through strikes. And their point is, actually, the causality is the wrong way round. So what you see is high inflation causing higher levels of unionization so that workers can then demand higher wages. So it's not that high unionization causes high inflation. It's high inflation causes high unionization.
That was always the fallacy in the argument that we couldn't have high inflation because we didn't have unionization like we did in the 1970s. And my argument was always that people will simply unionize when they feel under pressure. And the Bank of International Settlements, clearly, I haven't read this paper, have clearly done a lot of research that proves the sort of intuitive understanding of what people want to do when they're not particularly well paid and they see their real wages being cut, what they do to address that situation.
No, absolutely. Well, you're absolutely right, Richard. So this is charts that support that. And if you look at the chart on the left, you'll see that the level as inflation has come down, so unionization has fallen.
It's sort of it's like war gaming, isn't it? It's all game theory. It's what do people do to optimize their position in any given set of circumstances? And when they are individually under pressure, but they can get together as a group and reduce that pressure, then they will do so.
Yes.
So I think what I would really say, Keith, is that what's happened is the Bank of International Settlements has put out into the open the fact that we are probably heading into a wage price spiral, and any central banker that thinks this is a once and done is deluding themselves.
Well, we're seeing in the UK and the US and Europe, train strikes, and a lot depends on the government response to those strikes, whether they're successful, and the timing of going into recession. If we go into recession and the jobs market deteriorates strongly, then you'd expect to see actually these labor demands ameliorate, because essentially their bargaining position is significantly weakened.
And that is the control function, isn't it? That's what will happen. And that is why, in my view, this inflationary cycle will inevitably lead to recession. And it's unavoidable. But at the same time, what will also happen is that governments, where it's public sector, governments will have to give in, because, for example, the UK, we can't have swathes of the public sector going on strike and disabling our services. So in the sense, the government has to give in, but that actually forces us into a recession. Same will happen everywhere. And recession is totally unavoidable. It is a consequence of the high inflation that we have started. It's a consequence of mad monetary policies that have been in place for the last 30 years.
Yeah, but also the war in Ukraine, Richard, is going to make this recession particularly bad.
And that was a catalyst, possibly, for what's happening now.
Yeah. Okay, on to other charts, Richard.
Oh, sales of residential buildings in China. I mean, this just looks so unhealthy. And the Chinese economy, as we've stated before, previously, 30% of the Chinese economy was construction and building and construction. And, 30% of the Chinese economy has fallen off a cliff, yet their GDP is still up.
Yes. Good point.
And has China's housing market peaked? Well, I read today, I think it was, that there is a mortgage payment strike. A lot of Chinese people are refusing to pay their mortgages en masse because they feel that they've been betrayed by the government, which they have, into investing in what is actually a property Ponzi scheme. And I think there's an awful lot more to come out of the woodwork in the Chinese slow motion, I would say, slow motion property crash that is unfolding before our eyes.
That is very interesting, because that would be a very effective way of holding the government to account, actually.
Yeah. And I mean, as you'd expect, basically, with the difficulties in the Chinese property market and the fact that the economy clearly is in a poor state with the lockdowns, Chinese new home prices are falling. The total credit in China is steadily rising. I don't quite. I wonder where this credit is going.
Well, I think it's going to local governments. So local governments are issuing loads of bonds in order to try and prop up the economy.
Yeah, I'm sure you're right, Keith.
So this is really interesting. Actually, on Richard's point about how much you can believe Chinese statistics, well, we've had this big leak of data, and some of it has allowed researchers to look at what the actual Chinese birth rate is compared to what the declared numbers are. So the red line is the Chinese National Bureau of Statistics population numbers for the each birth cohort, and you'll see the leaked data depicts a much lower birth rate than the official data, and these are big differences. So as a result, going forwards, you expect the population of China to really slow, and the Chinese are going to have an economy that gets old before it gets rich, and the dependency ratio is going to explode. And also, when we talk about property, have the Chinese essentially overbuilt? Moving on to equity markets, Richard.
Thank you, Keith. A pretty poor week for equity markets. as a whole. It's noticeable the FTSE actually is, relatively speaking, for the year to date, is doing very well, and we've discussed previously why that is. What you say, Nasdaq is down 30% year to date, and the S&P 500 is down 20% year to date. Stocks Europe down 16% year to date, and there is, I suspect, more to go. Other interesting points, and Bitcoin's down 55% year to date. As we talked about earlier, the US dollar is very strong, and the pound is actually down 12% year to date. So if you'd had foreign currency assets, or rather not foreign currency assets, but US dollar assets, you would have made 12% on them simply by holding them.
Yeah. Although not if you've invested in the Nasdaq, Richard. So.
Good point, Keith. And earnings expectations are slowly being downgraded, actually quite quickly being downgraded, but they're being downgraded from quite a high level. And my view is they've got further to go. I don't know how much further, but I don't think we're at the bottom yet.
Lot further to go.
And there we go. Our earnings sentiment is collapsing, and that is a pretty scary looking chart for people who are long the stock market. But earnings revisions, the analysts are eternally optimistic. Presumably they get paid bonuses on the basis of how optimistic they are.
Yeah, I'm not quite sure how they measure earnings sentiment, but the bottom line is they're not cutting their estimates yet. I think they will do.
And strong dollar is bad for US corporate earnings, obviously, because of the dollar, the currency translation. And it certainly has been historically. I did read somewhere a comment that actually, with the US market being very tech centric, and it has some very profitable tech companies in it, whether that might change things slightly this time around.
Well, if you think of let's say Microsoft, who are always pushing me to subscribe to a family version of Microsoft Office at £60 per annum, then it's pounds, it's not dollars. So I'm expecting their earnings to take a hit.
Or the prices to go up.
Yes.
And then if you say, I don't want Microsoft, thank you, and they say, well, suit yourself, mate.
Yeah, well, I buy my licenses cheap off eBay. So on to commodities. Well, commodities are having a really bad run, and in particular industrial metals, which we will go into. But that is essentially saying that the world economy is slowing, that demand for industrial metals is falling and falling hard. So commodity markets are forecasting a recession, or saying we are seeing falling demand right now. So talking about energy commodities, bad week. Brent down 5% on the week, now down below $100 a barrel. WTI down 6.2. Dutch natural gas futures were down 2.5%, but still at massively elevated levels. Now, one thing I'd like to highlight is the difference in price between Dutch natural gas prices at $173 per BTU and US natural gas prices. Dutch natural gas futures are 25 times higher.
That's extraordinary. Yeah. And it's because the US can't get the gas out.
Absolutely. But if they could, Richard, I really think that the US would start placing export limits in order to reduce the increase in US domestic gas prices.
Yeah.
Coal rose another 1.2%. Uranium was down on the week. Now, really interesting numbers for US crude inventories. So last week, there was an enormous build of 14.9 million barrels on the week, including the SPR. If we exclude the SPR, private oil inventories rose by 21.7 million barrels. These are absolutely astonishingly large builds. And I repeat, builds. So no wonder the oil price is falling. suddenly we've gone from draws to builds. Now, I don't know, 1 week does not make a trend, but those are big numbers. US oil production actually fell last week back to 12 million barrels a day, up only 200,000 barrels a day on the year. So the world's swing producer is still not reacting to very high oil prices, and the Baker Hughes rig count rose by 2. So this is crude, and it's well off its peak. It's now 20% down. And when we talk about the inventory build, well, there is evidence that high oil prices are causing demand destruction in the US. So the blue line is average gasoline demand in the US over the period 2015 to 2019. The white line is gasoline demand now. You see it's well below average and falling. These are Dutch natural gas futures. You are talking absolutely enormous increases compared to last year. So last year, probably 25, and now 173. And this is US natural gas prices, which have recovered slightly. The fall was caused in part by the explosion at an LNG liquefaction plant. So as that comes back online, so demand will also rise. And reminder, over the coming decades, the US is planning to build a load of LNG export terminals, and that should begin to arbitrage the gap between European and US natural gas prices. And that is fundamentally bullish for US natural gas prices. Coal, still, the bull market looks very much intact. Uranium is sort of stabilized. Richard, industrial commodities.
Thanks, Keith. Again, so pretty poor week for industrial commodities. We've seen big falls in all the commodity prices, as we know. And so aluminium down 4%, 70% year to date. Cobalt was unchanged. Copper down 30% year to date, and just a 10% fall in the last week, which is huge. Chromium, small fall, but actually up on the year still. Iron ore down 8.3% last week, and 9% down for the year. Lithium unchanged. Neodymium, big fall actually. Nickel, very big fall. And despite that huge spike that we saw in the spring, it's now down year to date, down 7% year to date. And tin slightly up. Ferrovanadium down for the week, up nearly 9% year to date. And zinc down 8%. So a lot of the industrial metals significantly down last week. Whether that's the end of it or whether there's further to go, I think I don't know.
Well, I think a downwards trend is very much established now.
Yeah. So there's aluminium, cobalt, copper.
That's not a happy looking chart.
No. I do think it represents, at some point, it represents a buying opportunity for copper miners.
Yeah, it does. But, you know, we're heading into an enormous recession. Not yet.
Not yet. Chromium, iron ore, lithium, neodymium, nickel, tin, ferrovanadium, and zinc. So precious metals had a pretty bad week. Gold down 2.4%, silver 5%, platinum 4%, rhodium the only one that was up, and also virtually unchanged on the year. Palladium down 4.4%, and year to date, gold, silver, and platinum all down significantly, particularly silver. That's the chart of gold.
Very depressing, frankly.
Yep. Okay, seasonality chart for gold remains to be seen.
Yeah.
Silver.
That's an awful chart, actually.
Yeah. Platinum. Rhodium. and palladium.
Okay, thank you, Richard. On to rates. Well, after the surprisingly strong US CPI numbers, there was a general shift upwards in the yield curve, although you'll notice that the shift up was mainly concentrated at the near end. So UK two-year yields rose by 11 basis points, whereas the 50-year only rose by 4 basis points. Now, in the periphery, we actually had fall in yields over the week, which is surprising. So it would seem that fears of the coming recession in the Eurozone have trumped fears of fragmentation, and actually yields fell.
I find that that there's a contradictory it's a contradictory sort of explanation, isn't it, Keith? Because of course, if there is a recession in Europe, then government debt is more vulnerable to not being repaid.
Yeah, but there's also you get hopefully a fall in inflation, which allows the central bank to cut interest rates, and also people just flee risk assets. And you know what this is saying is that periphery government bonds are still seen as safe havens. You and I may not consider Italian bonds as a safe haven, but you know the market does.
Yeah.
For now.
Yeah.
So this is the market expectations for the number of 25 basis point interest rate rises in the US. And you see a big jump in following the CPI print. But if you look at the shape of the yield curve, you'll see the long end did not move up much and is down from 24th of June. So it rose in from beginning of July, but is well down on where it was a month ago. So the market is expecting rate cuts next year. Now this is QT, and you know when we talk about QT, the Fed balance sheet has shrunk by 0.8%, and you know the idea that it's going to get anywhere near reversing enormous rise, I think, is laughable. Now, this is the Italian 10-year, and I am surprised it has not risen, given the impending energy crisis in Europe, and reminder to watch our special on that. And in particular, given the dissolution essentially of the Draghi government. Now, if you look at the change in the Italian 10-year over the last week, you'll see that yesterday it leapt, and today, well, I suppose the president hasn't accepted his resignation. He doesn't have a working government, but it's falling again.
I'm sure the ECB has nothing to do with it, Keith.
Yeah, let's see what their plan is. So this is Greek, stable, UK, US. Now they do appear to have peaked despite the very strong CPI print. So something to watch. And we are now heading into August, but Q3, Q4 is the time to be worried.
Yes.
So concluding comments. Well, US job report was strong and showed no sign of imminent recession, but essentially the rest of the weekly just shows loads of indicators that the US and the world economy is slowing down. Commodity markets in particular have fallen very sharply and are indicating a big drop in global industrial demand. And above all, we think that given the reduction in gas flows from Russia over the last month, that a big energy crisis is coming to Europe this winter with huge implications for investments. Richard, what were you up to this week?
Thank you, Keith. So Regular viewers will know that I haven't actually been on here for 4 weeks due to holidays and then a family bereavement. And shortly after our last podcast 4 weeks ago, I sold most of my shares and went into cash. And I'm glad I did. I wish I'd done it a little bit sooner, but I'm glad I did, because since then there have been significant falls in what I would have been holding. So my change for the year is 0.7%, which is disappointing. And a consequence, Keith did two things differently to me. He was more heavily invested in oil and he got out sooner. So kudos to Keith for getting those two things right. But I did make one purchase, and that is this morning. This is hot off the press. Not very much, and I basically am sitting in cash. But day before yesterday, Gulf Keystone announced a 10%, what was effectively a 10% dividend on their market cap, and the share price dropped 15%. And it goes ex-div today. In other words, if you hold the shares today, you get 10% of the market cap back as a dividend. So I bought some, and we shall see. And this is the chart of Gulf Keystone, and I suspect that in the minds of owners of Gulf Keystone, it went ex-div before it went ex-div, if you see what I mean. But I don't know.
Richard, can I just come in actually? Because as you'll know, I was a big holder of Gulf Keystone in the last cycle, and I recently sold it, and it was a great performer for me. The trouble with Gulf Keystone is that all its assets are in Iraqi Kurdistan. And if there's a big fall in the oil price, essentially the Kurdistan government stops paying Gulf Keystone. So all the sales are through the KRG, the Kurdistan Regional Government. And then they pass on with a lag the revenues to Gulf Keystone. And last time during COVID, they simply stopped paying them. And you see that's why the share price collapsed so much during COVID. And if the recession were to get really bad, then that might happen again. But as you say, they kick off enormous amounts of cash.
Yeah. Very fair comment, Keith. And it may be that the answer is to sell it tomorrow. Well, on Monday. So gold, regular viewers will go that I have a significant holding in precious metals, which I still have. And of course, it's dollar denominated, and the pound is down 12% against the dollar year to date. So the gold has fallen. It hasn't actually fallen that much year to date. And my thesis is that the precious metal market is manipulated by the banks with the use of derivatives. And this chart basically the bullion banks have been forced to disclose information differently recently. And this chart shows, this chart is from the Office of the Comptroller General of the Currency in the US. So this is official data. And this official data shows that the precious metals derivatives are insured US commercial banks and savings associations. Now, there has been a change in the way the data is calculated. And this shows that they have left-hand axis, $500 billion of exposure to precious metals derivatives. That means that a 10% change, 10% upward increase in the value of the precious metal derivatives that they own, or the value, a 10% change, positive change in the price of precious metals has a 50 billion impact on their profit and loss account. They simply cannot afford to let the precious metals market prices increase until they get rid of these derivatives. So there is no doubt in my mind that they are seriously manipulating the precious metals market. And once that manipulation ceases, the price of gold will increase very significantly, in my view.
Actually, I could just come in here, Richard, because I was reading something during the week. So in general, I'm very skeptical of conspiracy theories, but I read a historic quotes from Eddie George, actually talking about the UK's banking sector's exposure to gold. I think it was in 2014, and him saying that they couldn't let the gold price go up because the UK banks had sold so many derivatives based on the gold price, and they had to cap the rise in the gold price. So certainly there have been instances in the past where this is absolutely true.
Yeah. Well, I think this chart all speaks for itself. Anyway, you have to draw your own conclusions.
Thank you, Richard. Well, I had a good week, up 1.7%. The all share was down 1.5%, and I'm having a very good year. Now, I had no buys, no sales. Now, this is my portfolio, and I posted these charts to our Discord earlier in the week, and I got quite a lot of feedback actually saying, I was taking very big positions. So I have moved essentially almost all my cash into US dollars. Now, and regular viewers will know that what I do is I have a look at the macro picture, and then if I have a strong view, I express that view. And to me, what's happened over the last couple of years, and actually the period where we've been doing this podcast, is I think the macro environment has been very easy to predict. There are big things happening. And what I see now is an impending European energy crisis, the worst we've seen in generations. I think the consequences of that are very predictable. And so to me, it may look like a big risk position, but this to me is a defensive position. I think there's only one hard asset, and that currently is the US dollar. So 64% of my portfolio is in US short-term bonds where I don't think there's that much risk. I do have a risk position in US 20-year plus bonds, and I may move more of my money into long-dated US treasuries as the yield curve, as yields peak and the far end of the yield curve starts to decline. But we will watch and wait. UK bonds, just not sure about. I'm really not sure how the US yield curve is going to react to the coming energy crisis and political turmoil, frankly, in the UK. So this is my equity allocation. I failed to sell all my Shell, and now it's fallen to a price I don't want to sell it. So I've got a small rump position in Shell that I will keep throughout the cycle for dividends. And I thought this was very good. And I think this is absolutely true. Investing is 80% weighting, 10% entry, 10% exit. And what's happened over the course of the last year is just we've had immense amounts of volatility. And when I bought oil, I was expecting to literally hold it for 5 years. And we've had so much go on that I've had to change my entire portfolio allocation. But I'm now kind of set, and I'm not expecting to make any big changes to the portfolio for a while. Certainly, I'm not buying any equities. I'm going to be patient. And this is where we are. So commodities are rolling over, stock market is rolling over. Have bonds begun to bottom? So I'm looking at moving into bonds. And the question I've got to answer is whether buying long-dated US bonds and having exposure to the strong US dollar is better than buying long-dated UK bonds, where I don't get exposed to a hard currency, but there's no capital gains tax on long-dated UK bonds. And reminder, the longer the maturity of the bond you buy, the more exposed it is to changes in interest rate. So if you're betting on yields coming down at the long end, then buying long bonds gives you potentially very high rewards, although you're also exposed to very high risks. And on that note, this is the 2071 gilt, where I've got a small position and it appears to have stopped falling for now. Now, the one company I wanted to talk about, and thank you to our regular viewer, Mike Lee, who emailed me about this and asked about Diversified Energy Company. Now, I have not sold any of it. So actually, it's my biggest energy holding now, biggest equity holding now on my SIP, because it's fully hedged. All its earnings are in US dollars. There's a structural bull market in US natural gas. And frankly, what's not to love? It yields about 12%. Now, the trouble is, as equity markets sell off, all equities go down. And so you'll see that despite all its great defensive qualities, the share price has come down from 124 to 110. But throughout that period and the coming recession, I fully expect Diversified Energy Company to be paying out 12% dividends. And in the long term, as it re-hedges its gas output, I think it'll be re-hedging at higher levels. So I'm happy to hold DEC throughout the cycle. Okay, that's it. Thank you for watching. Please can you press like and subscribe to the channel. And it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan.
Goodbye.
Goodbye. Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.